All done. All silent. Going. Go. So congratulations.
Welcome to the Current Market Insights podcast, brought to you by Harris Partners Real Estate. Each episode, we chat with real estate author and industry leader Peter O'Malley to discuss the current property market conditions and provide insights to assist you on your property journey.
Hello and welcome to another edition of Current Market Insights. I'm your host, Ciaran O'Brien, and with me as always is Mr. Peter O'Malley. Peter.
Ciaran, great to see you.
Great to see you, Peter. We also have another very special guest with us in the studio today. We have Mike Salvartsis, the Director of Real Property Buyers, a buyers agency in the Inner West. And Mike, firstly, let's say hello to our listeners. Mike.
Hi, Ciaran. Hi, Peter. Thank you.
Thanks for coming in, Mike. Mike, for all of our listeners, as I said, is the Director of Real Property Buyers based here in Sydney. He's also been a valuer for 15 to 20 years in property across Sydney, so he's someone who certainly knows the property market incredibly well. And we've had the fortune of having Mike in the studio before, and we thought since it's been a while, let's get him back and see how his experience of the property market has been going since we last spoke. So to kick off today's episode, Mike, I'm going to start with you. We have entered a bit of a phase, I think, in the global kind of economy, the global setup where things are really, really unpredictable. We have just conflict going all over the place. We have world leaders that are touch and go. There's just so much happening and it's impacting so much, whether it be financial or just global markets generally. I'd love to get your thoughts on how global activities are impacting the market for you on the buyer's side. Pete and I often talk about what's happening on the seller side, but as someone who's face-to-face with buyers every day, how is the global kind of uncertainty or circumstance impacting your buyers and your experience with people here on the ground?
Sure. There's uncertainty across global markets, and there's also a little bit of uncertainty across the actual Australian and local markets. Basically, we've got wars that are fresh and active, which creates uncertainty in relation to confidence in buyers. And I think that confidence takes on a different level depending upon whether you're buying a lower ticketed property as compared to buying a property that's more in that prestige space. So we've got the RBA who's increased rates in February, and there's talk about them increasing it again soon. And at the same token, petrol prices have increased significantly, which to some extent creates further uncertainty, but maybe these petrol price increases are doing the job of what the RBA is trying to do, and that is dampen confidence. So the confidence across the property market, it's very segmented. I think it impacts probably the prestige market more in relation to uncertainty. So if you're buying a $5 million plus property, it's not so much about interest rates, it's more around what's happening across equity markets, stock markets, and what's happening internationally. Whereas the buyer up to about sort of $2 to $3 million, they are a bit more interest rate sensitive. And what we're starting to see is fewer buyers across properties, and to some extent, that's impacting prices and repricing and transactional activity.
Just, I guess, a very narrow focus on one of the points that you make there. Looking at some of the global events that have occurred, let's say over the last 18 months or so, 12 months or 18 months, do you notice in that kind of very transactional period where something has started or is happening, do you notice a significant shift in either the number of people contacting you or the activity level or sentiment of those people that you're already working with? Or is it more, a more measured kind of transition in activity, or do you get those sharp kind of shifts when Iran starts or kicks off? Do all of a sudden you get less inquiries? Is it that rapid?
Yeah, look, our business. So we're buying for both owner occupiers and investors, predominantly in the Sydney metro area. We're seeing a lot of investment inquiry. We're seeing first home buyer inquiry, and we're seeing a lot of downsizing and upsizing inquiry. It's a bit too early to tell the direct impact in terms of the most recent interest rate increase and what's happening in Iran. It's very difficult to measure that. And the property market is a bit more, it takes a little bit longer to absorb and to do a stock take on it. But I do believe the way we're seeing the market today, it's very similar to what we saw at the end of last year. So at the end of last year, pretty much from about September to December, we saw buys, and there wasn't any urgency to buy. And, the market had pretty much felt as though it had closed earlier this year. It came back in January pretty strong, and it's been recently strong in January and February. And now we're just starting to see sort of that uncertainty. Markets do change. The residential market changes a lot quicker than what the commercial market does, but I think the jury's still out now to see exactly what direct impact these global factors are going to have.
Just before I throw to Peter, just one final question for you on this point. You've obviously talked about the fact that there is a bit of a lag between what's happening and what the buyer activity or sentiment might be. But as someone who also deals in a large capacity with selling agents, do you see any changes in either behaviours, pressure levels, activity, confidence from the selling agents when these things are going on?
Yeah, look, I've got to tell you, based on what we're seeing, we're aware of a few properties that have been on the market that have gone through 2 or 3 campaigns in a short period of time, and we're seeing a repricing. And I've got to tell you, I think the onus is on the selling agents, because if they either don't quote it correctly or don't price it correctly, the impact can potentially be a very average campaign, and it might even result in an extension. I am aware of 2 properties, which we spoke about last week on one of our Instagram notes, where basically, a $5 million property in a waterfront reserve location, it's a very tightly held pocket. I was at the auction on Saturday morning just to observe, and they basically cancelled the auction on that morning with all the crowd there. And I'm aware of another one that was quoted around $4.7 million just on the city fringe. Non-active campaign. The day before the auction, the campaign got extended by another month, and now it's been repriced at about $200,000 less than what it was in the initial campaign. So I think if the challenge there for selling agents is that if you're not pricing the property correctly, unfortunately, it's going to be a disadvantage for the vendor. And as a buyer's agent, we love that, because it means the campaign hasn't moved well and there's opportunity for potentially better buying.
Great points. I think the thing in my time in selling real estate that I relate this to the most this period, Ciaran and Mike, is the Iraq War. And at that point in time, there was a much more defined or telegraphed period of the US potentially striking Iraq. You might remember George Bush offered Saddam Hussein a countdown, whereas from when we're recording today, the strikes on Iran by the Trump administration were exactly 7 days ago, and they happened without warning. And that was part of the effectiveness of the strikes, is there was no countdown. It was Iran thought they were still negotiating with the Americans when in reality the Americans had a very, very clear plan with the Israelis, of course, of when they were going to strike. And the reason I highlight that is that with the Iraq War, we saw buyer sentiment pulling off until people saw how the Iraq War was going to unfold, where the market actually didn't have any time to adjust to last weekend strikes, because it just happened out of nowhere for us mere mortals, if you like. So the day that we've just concluded in the field is the first weekend after the strikes, and there's no doubt that inspection numbers were down. Lookers were down. Now in Sydney today, filthy hot, humid Saturday, so it wasn't really a day for discretionary or B-grade buyers. It really, the people we were seeing active out there today were people that wanted to purchase a property and were going to. I spoke to some auctioneers about what their run sheet looked like for the day, and it was probably mirroring what we're seeing more broadly. It looks as though the auction clearance rate in Sydney is now starting to solidify just below 50% again. As we've discussed in the past, an auction clearance rate that is stubbornly stuck in the 40s suggests price falls. That's not uniformed price falls, but it's price falls in pockets all the same. And I agree very much with the point that Mike's just made. is if this is a drawn out, knock them down, drag them out, lengthy war in Iran, that will impact stock markets. And if it impacts stock markets, the prestige end of the Sydney real estate market will be more impacted than the bread and butter side of things.
Mike also mentioned a point that I'll throw this back to you, Peter. But Mike mentioned that he is seeing a combination of first-home buyers, which we've talked about, a little bit at length, I think, certainly after October. But he's also mentioned there's a pretty significant number of investors coming back into the market in his eyes. Now, you and I think I ask you this almost every time we talk about whether or not the investors are back on the ground and whether or not they're back out there buying, and you consistently tell me probably not. So I'm actually really interested to get your thoughts, and then if we, in some way try and uncover where that difference is. Why is the buyer side seeing more investors, but we're not actually seeing them at the seller side? Yeah,
well, Mike and I agree a lot on a lot when it comes to real estate, but we're actually having different experiences as far as this goes. And I think the answer to the question is Mike's seeing lots of investors, but it's geographically based. Yep. It's in markets that we don't service. So here in the inner west, given what property prices are and what rental yields are versus what land tax is, etc., investors that are already in the market and sitting on good paper gains are happy to continue renting their properties out.
Yeah.
But in terms of, is the market in the inner west at a point where it's attracting new investors into the market? Absolutely not. So we maintain that position that there's very few, if any, investors in the inner west market. But I've trusted Mike's voice on real estate matters for 26 years. And if he tells me there's a lot of investors active in the market, there's a lot of investors active in the market. But I'll let Mike explain where you're seeing that.
Yeah, look, the common question, so we ask investors, like some of the questions that we ask them is, are you looking to buy a unit, a townhouse or a villa, or are you looking to buy a house? If you've got let's talk about a $1.3 million budget, right? So you can buy a 2-bedroom unit in the inner west, okay? We're seeing some resistance in relation to strata title at the moment, and those buyers don't really care geographically where they're buying as long as the fundamentals are there. And what they're saying to us is that they want to buy something with a land component. And we've bought, in the last 6 months, we've bought 3 house and granny flat properties in Western and Southwestern Sydney. They're on about 600 square metres of land, council approved granny flats, so no dodgy stuff out there. And basically the yields that we're seeing that are being achieved is anything from 4.2 to 4.6%. Now, if I was to equate that to the inner west, it's difficult to find something in the inner west at that 4.5 to 4.6% yield, unless if it was maybe a studio or a one-bedder. Or we were looking at buying on the city fringe, say your Zetland, your Waterloo and Alexandrias, where they can achieve 4 to 4.5+% yields. But the issue is they're high density areas with high density development, and a lot of those buildings have issues with them. So the issues we're seeing is, owners, corporations and developers in court. We're seeing rectification issues in relation to waterproofing. And we're also seeing wall cladding issues that are slowly being addressed, but strata levies on those units that are generating the 4.5% yields, we're seeing anywhere from $2,000 to $3,000 a quarter.
So you're saying gross yield there?
We're talking gross, yeah.
Gross, yeah. So that's before you've paid the strata levies,
yeah. So basically,
rates and water rates.
And so what we're finding is that, we're having open and robust discussions. And our clients are telling us, if we can get the land option, and it's in Western or Southwestern Sydney, we still own the land and we've got 2 income streams. Why not? And what we're saying to them, the vacancy rates in the inner west and the vacancy rates in Western Sydney at the moment are 1%.
Yeah.
There is a difference in what I believe to be tenancy risk. So there's a higher, I think it's a bit riskier. The tenancy risk is a little bit riskier in Western Sydney and Southwestern Sydney as compared to the inner west. But that doesn't seem to phase or be a major concern to our investor clients.
Yeah, so look, I think what Mike's just outlined there also highlights the role of the state government in all of this. As we know, Chris Minns's philosophy is he wants to build up, not out, when it comes to new dwellings. So he's making the high-density areas, or intends to, make the high-density areas even denser through more apartments.
That's true. Yeah.
So when you're talking about supply and demand, if he's talking about building up, not out, the house and land packages and the houses in the suburbs, they've normally never enjoyed the price growth of the inner city, because every time there's pressure built up from a supply-demand imbalance, they just release another housing estate, whether it's a Glenmore Park or a Box Hill or a McGrath's Hill. But if the strategy now is, no, we just don't want Sydney to keep expanding, we want people to come into the infrastructure of the inner city and families to live in apartments, which sounds horrible and sad, but that's what he's saying he wants to see happen. Well, that's going to also create an excess demand relative to supply in the suburbs, isn't it?
Yep. And the other thing too, Peter, is that 10 years ago, people were buying and saying, well, where is this location compared to the CBD?
And we're not seeing that now because the city's decentralised.
Saying, well, the dialogue's changed. It's like, well, if I'm going to go to Western Sydney or southwestern Sydney, I want to make sure, well, we've got an airport that's going to be opened this year. We've got an airport that's going to be opened.
The roads, you've got the freeways.
Yeah,
that
so
have come up.
what you're finding is that the commute, the travel, the metro...
Mate, the metro's a game changer,
yeah,
honestly.
And what that's doing is it's no longer what it used to be, or how many kilometres is this from the Sydney CBD. Now it's more along, well, if I go to Western Sydney, how far off am I from the airport, from the major shopping centres, from the metro and all the other services? So it's a very different discussion.
And I can work from home.
Yeah.
Yeah.
It's amazing to me just how, talking about the metro, I absolutely love it. It is so efficient. I drive from home in Homebush out to Parramatta, and if I take the non-freeway option, it takes me longer than if I was to drive into Sydenham and jump on the metro and catch it out. I don't think the public transport infrastructure is good enough for Sydney. It has never kept up, but I feel like we're actually on the right track to do, or to better decentralise Sydney. A question for you, Mike, and you may not know the answer to this, to be honest, but Pete and I often sort of talk about where, as Sydney's yield decreases with prices continuing and supply and demand being a concern, the other markets across the country have shifted, particularly post-COVID, and there's been less and less opportunity to grab a bargain and get a great yield and growth. For people that you deal with, potential investors in Sydney who may decide that the yield is not good enough, or they don't want to go, to Ingleburn or to wherever they might go, Appin or something, to get a house and land. Where in Australia elsewhere have you heard of these particular investors thinking, hey, we can actually still get a reasonable deal?
Oh, yeah, look, it's very obvious. I'll just explain. The most common, we get investors who say, I've got an $800,000 budget and I want to buy a house as an investment. So we're saying, look, unfortunately, we can't help you. So we're referring those clients to buyers agents in Queensland, in Melbourne, in Adelaide and Perth. And I can tell you now, there's been a big shift in investment activity where, unfortunately, Sydney's become just too expensive for what they're looking for, and they're going to other states, and they're getting better, or they've probably had better growth since COVID, and they're generating better yields. But those markets, as I said, you've got to be careful when you're going into those markets because, the Adelaide market, I believe, is fairly shallow. There is migration that's increasing, but it's still a shallow market. Same with Tasmania, which is getting a lot of write-up at the moment. Queensland and the Gold Coast, the driver in the Gold Coast, I was up in Coolangatta 2 weeks ago, the driver is the Olympic Games.
Yeah.
So what you're finding is that, yes, people are moving, they're following affordability when it comes to the house, and they're very open to investing in other states because they're getting more value for their money in other states and they're getting better yields.
Mike, let's cut across to first home buyers. As we know, first home buyers were given government support to get into the property market last October, and there's no doubt that it created a rally of buyers of that persuasion in October and November. In the markets that we serve, it feels like that rally has fizzled now.
Yep.
And it was the people that wanted to take advantage of it got got in early and acted early, and there was a sense that it could be so stimulatory to drive up property prices, and maybe it did for a month or two. But it feels like that story has really settled down with first home buyers going overs. But I'm not saying that's the case across the city. That's just our experience here in the inner west with the markets that we experience. Do you have any sense, as you're out there looking on behalf of investors, how enthusiastic are the first home buyers with these armed with these government incentives at the moment?
Yeah, look, the rules say $1.5 million is the first home buyer guarantee sort of threshold, and that's the price point that investors play in. Investors are becoming more active and prominent in that space. We've bought a lot of first home buyer properties since October when it was launched, and I believe that market's increased by about 5%, and that would have been up to about January. The first home buyer inquiry, it's still there, but it's not as solid as what the investor inquiry is at that price point.
So investor activity is overtaking first home buyers?
I believe so, yeah. And I think in the last sort of, I had a read of one of the publications the other day, and I saw that first home buyer activity is up at the approvals for that. Lending approvals are up to about 17%, and the investment activity is up by about 37%.
So that leads us probably into our next point that we're going to cover today, and that's taxation. There's a strong sense the federal government are going to come looking for extra taxation when it comes to property in the May 2026 budget. What are your thoughts on what they're playing with there?
Look, governments that have, potential governments or governments that were favoured to win have gone down the capital gains tax and negative gearing avenue before. They've lost campaigns in light of that. I think the capital gains tax and lowering that the discount to 30%. Look,
that's what's speculated.
Yeah, that's what's speculated. It's not approved. A lot of our clients haven't really opened that discussion with us. They haven't expressed concerns at this point in time. It looks as though it's an easy grab for the government. Whether it transpires or not, I'm not really sure. But I'll tell you now, if you were financially in the position and this reducing the capital gains tax took place, and you could afford to hold those properties, then why would you sell them? Wouldn't you just hold them and just reap the benefits from them?
Well, I think the answer to that is that this adjustment on capital gains tax is on property only. It's not on shares. It's not on other asset classes. Yep. So it's driving investors out of property. I think that's the answer.
Yeah.
Now, governments are specials for putting thought bubbles out there that get everyone up in arms one way, and then they say, no, we're not going to implement that. This is what we're going to implement. And they come back with something a tad more reasonable so everyone feels as though they've had a win, if you like. Yeah. But there's a very simple reason why it could create a flood of listings on the market, and that is what is being speculated at the moment is property is only subject to this new taxation.
Yeah. Look, it's not, the rules aren't very clear. I think we're going to hear more about it in the May budget. So more of it will come out. But look, anything to deal with property taxes historically has always been a big talking point. And, owning your house and owning one investment property, that's what everyone tries to achieve. And penalising that, I think, is a problem.
On your point, sorry, Peter, do you think that, when you've got ETFs out there returning 7, 8, 10% pretty regularly with minimal fees, who still benefit from the older capital gains, if this goes ahead, benefit from the greater reduction, do you think it will be significant enough for people to shift asset class entirely, sell off the property before the changes come into effect, and then just invest in a stable, reasonably well-earning ETF or hedge fund of some kind, reap the rewards and save money on taxes?
I won't speculate where the money's going to go, other than to say that if you make these capital gains tax changes to just property, so i.e. there's a disincentive or a higher taxation scenario for property investors versus all other asset classes, you're going to push investors into other asset classes, there's no doubt. Yeah. So what I don't like about this, Mike's touched on there, oppositions have lost elections on trying to introduce new property taxes or change the taxation regime. What I don't like about this from being in property is the people don't get to decide on this. Bill Shorten, like him or don't like him, he ran an election on his agenda where the existing government have not gone to an election saying they're going to do this.
Yeah.
But they're not talking about it in the May budget if you're to believe the messaging that's coming through. They're going to implement it in the May budget and it kicks in on July 1, 2026.
Yeah.
And it won't be grandfathered. So you do see the potential for a lot of investor selling between the May budget and July 1. We'll update our audience as that unfolds, but that's a scenario that's brewing out there at the moment.
And that's not a lot of time. We've often talked about how long it takes to actually get a campaign successfully off the ground and close through. Do you think there'll be any sellers who may be a little jumpy or a little easily spooked who might even just go slightly earlier? You know, on the
I'm already fielding calls from people. And it's something that I'm dropping on landlords at the moment, saying you're sitting on a big paper game. We had someone today that has 3 investment properties and they sold one today. And one of the things I said you should work with this offer and just go with it is because of the capital gains tax changes that are being foreshadowed. And I said if they are introduced, you could sell for a slightly higher price after July. But given the tax you'll pay, your net position will be worse off. So the news flow, as we've already discussed today, is so dynamic. It's so full. There's so much happening, it feels like on a weekly basis. This one is slipping under the radar, and it could become a big issue very quickly for a lot of people.
I can't help but feel it's by design. You know, there's so much political gaming out there that quite often you can slip it in. But I think the fundamental thing here is that, you know, changing the capital gains tax for whatever reason, whether it's revenue raising or whether it's to have some impact on affordability or housing supply, still will not fix the fact there is not enough houses being built to meet demand.
Hence the shortcomings of government.
Repeatedly. One of the other things that has come through recently, and I know, Mike, we were talking about this just off air beforehand, is some proposed changes potentially to negative gearing laws as well. I know it's just kind of filtering in the background and not necessarily anything concrete yet. But are you able to just give some comments for our listeners on what you've heard and what you think those changes may mean?
Yeah, look, my understanding of it is that, you know, greater than 2 investment properties won't benefit from, won't see the benefits of negative gearing. Our clients are not really talking to us about that. So this was sort of like slipped in about a week and a half ago. And it was more the talk around capital gains tax. And then next minute it was, now we're going to hit, investors who have more than 2 properties. So it's happened quickly. I personally don't think investors have had time to digest it.
Absolutely.
To work out what their position
that's
is.
That's part of the implementation, right?
They haven't had time to think about it. Once again, it looks like policy on the run. But
it's not. It's a way of getting it through.
Yeah. So look, I mean, I've got to go back to, the fundamental things in relation to the where the property market is and the supply and demand situation. We're doing everything around it other than addressing the real issue. And the real issue, we're not building quick enough. We're not building fast enough. It costs a lot more from the planning phase through the construction phase and marketing phase to get properties on the market. And if you really want to address unaffordability, get more buyers in the market and tackle sort of the population and demand situation, then you've just got to build faster and quicker. And unfortunately, that's not what's happening at the moment.
Or reduce immigration.
Yeah.
Mark Carney was in Australia this week, the Canadian Prime Minister, and he's overseen a rental market that's dropped 8% in Canada. It started with Justin Trudeau before him, but they started cutting their immigration numbers, and both the housing values and rental values have begun falling, not crashing, but certainly pulling back, subsiding in Canada. because they've pulled back on immigration.
That was in there during the week, wasn't it?
Yes, it was, yeah.
What do you think the actual... I agree with all these points, but what do you think the actual flow-on would be in the market if they did implement both these changes, realistically? You know, if the government said tomorrow that come July 1, you get 30% capital gains benefit as opposed to 50, and you can no longer negative gear anything beyond 2 investments, what do you think would actually happen? Because I honestly feel like government repeatedly just throw out ideas because it's being spruiked by the Greens or, you know, lobby groups on the left that think that this is the solution to affordability. They constantly say it. I reflect on Max Chandler-Mather just like hammering these lines for 18 months or so in Parliament that if you just remove negative gearing, housing will crash 50% and we could all buy a house. I mean, that's absolute nonsense. So what do you think the actual flow-on would be?
Rents go up.
They have to, right? Because supply fall. I don't see how people think that housing will just magically become free or cheap if you take away the incentive. Some may sell for cheaper, but the vast majority of people will what? Would you just change ownership in the family and keep the benefit going?
Well, the changes that are being discussed are anti-landlord. The system is already anti-landlord. The more you keep pushing it down that way, the more existing landlords sell out. As I've already discussed today in the Inner West, you don't see new landlords entering the market like they used to. So the adjunct of these changes will be the rental market goes up.
It has to. There's no other flow, right?
Property prices might go down, no doubt about that, if there was too much selling at once, but rents would ultimately go up.
Yeah, but as we always say, even then, the people that sell have to buy something else, right? Like it's not
an investor. No, they don't.
Oh, no, if they're an investor, that's right. Yeah.
They can put their money, the investors will put their money, they'll redirect it elsewhere.
Yeah. Or if there's no incentive, they just won't do it in property, as we said.
Mike, New South Wales government are really doing their best to try and clamp down on underquoting.
Yes.
What are you seeing out there as far as underquoting goes, and how's the game being played?
Yeah, look, it's my understanding there's a name and shame register out there at the moment, and it's pretty much targeted around part of that is targeted around overquoting and underquoting. It's more so underquoting, I should say. But basically, look, we're seeing, underquoting is where the market is. We're seeing examples of that where when we talk to our clients, we say, look, the selling agent's saying $1 million. Let's just put that to the side and do our own homework and work out what it's actually worth. But we monitor results from the time that their properties are inspected to where they sell, and we're seeing variations as much as 30% on the initial guides that are being provided.
So obviously it was customary for underquoting to be 10% below the reserved 20 years ago.
Yep.
10 years ago we saw underquoting getting out to 15 to 20%.
Yep.
Here we are in 2026. 2 state governments have had a serious crack at trying to control the tactic, and you're telling us now underquoting's out to 30%.
Yeah, I've seen it as high as 30%.
Yeah.
And look, the biggest issue is, you need people on the ground to monitor this. We have clients who, that can potentially spend. We say to them, don't get a strata report, don't get a building report, don't get a contract review until we tell you what we think the property's worth. So we're trying to minimise. We're trying to minimise those unnecessary costs on a property that hasn't been quoted correctly, and save clients as much as $1,000 each time to compete for a property that they never had a chance on because it wasn't priced correctly. So we flip it around, and our clients love that. But, I would hate to be a buyer out there who doesn't have experience, isn't familiar with the market and price points, and then relying on a selling agent as a quoting guide, because I think that's fraught with danger. As I said, and realistically, you should do your own homework. Whether you use a buyer's agent or not, it's totally up to those individuals. But at least do your homework to see whether you think it's been priced consistently. And there are certain agents out there where we know that consistently they will underquote.
So our advice to people who are concerned about underquoting is the same as yours. Believe nothing and check everything.
Yep.
Believe nothing the agent tells you and check everything with your own independent research.
Yep.
So you're absolutely right there. And those that are dealing with the selling agent and dealing and worried about underquoting, that is the right advice.
You've got to do your own homework.
Yeah.
You know, regardless of whether you do it yourself or use a buyer's agent, you should always challenge your buyer's agent anyway. Right. What we do is when we look at a property and we're preparing to go to auction or before we submit any offers on a property, we say to the client, property's worth between X and Y. That is the market value of that property. And if you consider and you're happy to buy within that range, then you won't have a problem from a valuation risk point of view. So for instance, if we buy the property, that client then goes to his broker and says, I've just bought it and paid $3 million. We've de-risked that property because we've put it through the motions. So we've looked at all the sales that the valuers would and said, well, you know, it's worth between 2.5 and 2.7. There's your parameters. Now, if you want to go and spend $3 million for it, that's okay, but we've documented what we think it's actually worth.
Which is what a good buyer's agent stroke valuer does, right?
Yeah, and a buyer's agent should not be incentivised on the final number. We charge fixed fees. So whether you buy that property at $2 million, 2.5 or 3, it'll always be the same number.
Yep.
So we're providing a service, a quote as a service, but there are a lot of buyer's agents out there who will charge you a percentage of whatever the number is. And that fundamentally is a conflict of interest, in our opinion.
What's the kicker, Pete?
Yeah, that's right, indeed.
I just on this topic, interestingly, Peter knows this story well, but when my wife and I were trying to buy some years ago, we were victims of underquoting as buyers massively. You know, went to an auction, great turnout, and it went from memory, it was about 45% above the guide. It was a huge difference. And we were just pawns, you know, wasted all this money, as you say, go through the motions. And I remember lodging a complaint at the time, leaving a negative Google review, you know, doing all the things that were within my power. And not only did my Google review get taken down somehow, despite it being the truth, my complaint I never heard back. Interestingly, and this is all tied into, I think, fair trading and the government's activity here, I recently lodged another complaint on behalf of a friend of mine who was trying to buy. And within, I think it was 2 weeks, I heard back from fair trading. They said, we're actively investigating your claims. Send us one more bit of info, and they told me exactly what they wanted, and we'll take action. And I don't know if anything will come of that, but I finally get the feeling that fair trading in particular are taking this issue seriously. The name and shame register, whether or not it turns out to be good, I don't know. But I definitely feel like there is more energy and activity to try and stamp this out.
Oh, there is. So just want to add one more thing on the underquoting before we close. And agents... the reality is, why do real estate agents underquote, Mike?
It's just to generate buyer inquiry.
Because it works.
Yep.
Yeah.
That's Pete's favourite.
Yeah, it's
Is it compliant? Is it legal? Is it fair? Is it the right thing to do? No. Why do they do it? Because it works.
Yeah.
It creates feverish bidding activity for the agent to then leverage the buyers off each other and get the right result for the vendor.
Yep.
As we know, if a real estate agent thinks and writes on their agency agreement that the property is going to sell between 2.5 and 2.75, they can't quote a number lower than 2.5 to the marketplace, yeah?
Yep.
What we're seeing, and I encourage buyers to look out for this one, as a way of underquoting without underquoting, agents who might have 2.5 to 2.75 on their agency agreement being the 10% range, they're not going out there anymore and saying the guide's 2.35. But when Mike Salvartsis comes through and says, this is a nice house, what do you think? Mike's saying, we've got interest at 2.35. So what Mike's doing is getting a bargain hunter to give him a verbal or an email offer at a low number, and then he's saying to the buyers as they walk through the house, this is the number that we've got at the moment. This is what I'm being told as the agent. Now, this will get stress tested at some stage, this tactic, but it's cute, right?
Yeah.
Because the agent's saying, hey, my range says 2.5 to 2.75, and that's all I'm telling the buyers what I think the property's worth. But are you saying that I can't tell a buyer that I've had an offer of 2.35?
Yeah.
And trying to justify and have the next buyer go, well, geez, if the interest is only at 2.35, this looks like a $2.6 million house to me. I might turn up and have a go.
Yeah.
And the only problem is these 15 people have been told the same story.
Of course they have. Look, really great chat today, guys. Mike, in particular, want to thank you for coming in and talking with us. I certainly think, actually, I feel like every time we talk, we're saying that the future is looking interesting in property, and it's looking very interesting globally. But it's always really refreshing to get the insights from someone who's on the other side of the fence. You know, we often talk about the seller and the vendor's experience, but we speculate on the buyer experience within the limits of being a selling agent. But it's always very refreshing to get the insights from someone who's working with buyers directly all the time. And it is, to me, it highlights there are differences on the market and on the ground, some of which may not even make it to the other side of the fence. So definitely want to thank you for coming in and talking with us today.
Thanks, Ciaran. Thanks, Peter.
Thanks, Mike. Great to see you.
Thank you. Take
Cheers.
care.
And thank you to you, Peter. And thanks to everyone for tuning in to Current Market Insights. If anyone is in the market for a buyer's agent, I'll leave Mike's details in the description for today's podcast. That's Real Property Buyers in Sydney. But for all those out there, thanks for listening to Current Market Insights. We look forward to speaking with you next time.
Thanks for joining us on the Current Market Insights podcast, brought to you by Harris Partners Real Estate, the podcast providing real estate insights you won't find anywhere else.